Hello guys, welcome to Path and Lighter. This is Nikita here. Let me tell you something about myself. I have done my law graduation from Delhi University. Also, I have done my BCom honors from Calcutta University, and I have a 5 years of experience of teaching. Now, let's proceed with today's topic, that is accounting. Now, we will be dealing accounting in two parts. First half will be done in these videos, and the later will be coming in the later videos. Now, I'll start with the today's topic, introduction to accounting. Accounting is a language of business. It is a process of identifying, measuring, recording, and communicating the required information relating to economic events and other organizations. Now, the first book on double entry bookkeeping was by Luca Pacioli's Summa di Arithmetica Geometria Proportion and Proportionality, that is review of arithmetic and geometric proportions in Venice, and that is too early, that is in the year of 1494. Now, accounting information should ensure to provide information for making economic decisions, serve the users who rely on financial statements as their principal source of information, provide information useful for predicting and evaluating the amount. Now, um, provide factual and interpretive information by disclosing underlying assumptions on matters or subjects. Financial accounting assets in keeping a systematic record of financial transactions. Cost accounting assists in analyzing the expenditure for ascertaining the cost of various products manufactured. Management accounting deals with the provision of necessary accounting information to people within the organization. Now, two main user groups who use accounting. First, internal users, and second, the external users. Internal users are mainly the management people who needs timely information on cost of sales, profitability, etc. for planning, controlling, and decision making. And the second were the external users who have limited authority, ability, and resources to obtain the necessary information to have reliable financial statements. Now, terminology. Entity means a thing that has a definite individual existence. Business entity means a specifically identified business enterprise. Assets are economic resources of an enterprise that can be fully expressed in monetary terms. That is, assets are expressed in monetary terms. That is of two types, that is fixed assets and current assets. Fixed assets are assets held on a long-term basis, such as land, building, machinery, etc. Whereas current assets are on a short-term basis, such as debtors, stock, bills receivable, temporary marketable securities, etc. Now, liabilities are the obligations that an enterprise have and has to pay at some time in the future. Liabilities are classified two types, that is long-term and short-term liabilities. Long-term liabilities are those that are usually payable after a period of 1 year, and short-term that is payable within a period of 1 year. Now, capital amount. Capital amount invested by an owner in the firm is known as capital. It can be in the form of cash or in assets. Now, sales are the total revenues which they incur after from the goods and services after selling it. Now, revenues, incomes are the amounts of the business earned by selling its products or providing services to customers, called sales revenue. Other items of revenue can be commission, interest, dividend, royalties, and rent receipts. Expenses, costs incurred by a business in the process of earning revenue are known as expenses. Now, expenditure. Expenditure is the spending of money or incurring a liability for some benefit. Now, profit of excess of revenue for a period over its related expenses for a particular accounting year is known as profit. Now, discount. Discount is a deduction in the price of the goods sold. It is offered in two ways. Offering deduction of agreed percentage of list price at the time of selling goods, and the other, this is known as trade discount, and it is generally offered by the manufacturers to wholesalers and by wholesalers to retailers. Now, and the other one is After selling the goods on credit basis, the debtors may give certain deduction in amount in case of the amount within the stipulated. Other discount is cash discount, and cash discount is an act as an incentive that encourages prompt payment by the debtors. Now voucher is a documentary evidence in support of a transaction. Goods refers to the products of the business. Drawings are the withdrawal of money and or goods by the owner from the business for personal use. Now purchase a total amount of goods procured by the business on credit and on cash. Now stocks are the inventory. It is a measure of something on hand, goods, pair and other items in a business. Now duality principle. Duality principle is what we can say in this type of formula, like assets equals to liabilities plus capital. The concept of money measurement states that only those transactions are happenings in an organization which can be expressed in terms of money, such as sale of goods, etc., are to be recorded in the books of account. Now, the concept of going concern assumes that a business firm would continue to carry out its operation indefinitely, that is, for a fairly long period of time. Accounting period refers to the span of time at the end of which the financial statements of enterprise are prepared. Now, the cost concept requires that all assets are recorded in books of accounts at their purchase price. Now, the concept of revenue recognition is that the revenue for a business unit should be included in the accounting records only when it is realized. That means the concept of revenue is that only when it is realized it will be added in the accounts. Process of asserting the amount of profit earned or the loss incurred during a particular period involves deduction of related expenses from the revenue earned during that period. Information provided by financial statements are used by different groups of people such as investors, lenders, suppliers and others. The accounting information provided by the financial statements would be useful in drawing conclusions regarding the working of an enterprise only when it allows comparisons, etc. Now, the concept of objectivity requires that the accounting transactions should be recorded in an objective manner, free from the bias of accountants and others. And double entry system is based on the principle of dual aspect, which states that every transaction had two effects, that is receiving of a benefit and giving of a benefit. Now, basis of accounting. Two broad approaches have been adopted for accounting, that is cash basis and accrual basis. What is cash basis? Cash basis is the entries in the books of accounts which are made when cash is received or paid and not when the receipt or payment becomes due. An accrual basis is the revenue and cost are recognized in the period in which they occur rather than they are paid. Now, recognizing this need, the ICAI constituted an accounting standard board in April 1977 with developing accounting standards. The main function of ASB is to identify areas in which uniformity in standards is required and develop draft standards after wide discussion with representative of government, public sector, etc. Now, ASB gives due consideration to the international accounting standards. As India is a member of International Account Setting Body, ASB submits the draft of the standards to the Council of the ICAI. Now, accounting standards are written statements. What are accounting? Accounting standards are written statements of uniform accounting rules and guidelines of practices for preparing the uniform and consistent financial statements and for other disclosures affecting the user of accounting information. And generally accepted accounting principle GAAP refers to the rules or guidelines adopted for recording and reporting of business transactions in order to bring uniformity. All accounts are divided into 5 categories, that is assets, liabilities, capital, expenses or losses and revenues or gains. Two fundamental rules are followed for recording the changes in the account, that is for recording changes in assets or expenses, that is loss. Increase in asset is debited and decrease in assets is credited. An increase in expenses or losses is debited and decrease in expenses or losses is credited. What we known as the golden rules. Now, for recording changes in liabilities and capital revenue gains, increase in liabilities in capital credited and decrease in liabilities in debited. Increase in capital is credited and decrease in capital is debited. Increase in revenue or gain is credited and decrease in revenue gain is debited. Now this is all for today. Subscribe to this channel for free education and please promote it among friends. For any queries or suggestions, do mail us at pathenlighter@gmail.com. Thank you.